A large fib is at least 2 levels larger than the small fib. Also note here, unlike other examples, where there was one fib with an up and one with a downtrend, this one has both fibs in an uptrend. Both fibs may also be in a downtrend, it doesn't matter. By now you probably noticed the areas marked in yellow show areas where fib levels from the large and small fib are close together to reveal approximate price ranges that will present support and resistance, and be likely areas of reversals. In theory, the concept of combined fibs reveals the most relevant areas where price is more likely to reverse. On this chart, there is the additional concept of lining up fib levels and zones of a combined large and small fib with past reversal areas. The remaining areas not highlighted are single fib levels. Normally, these would be less relevant and significant compared to areas where combined fib levels encompassed past reversal points. However, in this example, both single fib levels, the small 2.36 and 0.5 levels, line up clearly with past reversal points. So while they don't combine with a large fib level to form a zone, they do have a proven track record of reversing price. A combined fib zone is one form of extra validation, as is lining up fib levels with past reversal areas. When both these elements are combined, a reversal is more likely to occur at that particular price region. Here we see the results in the form of future price action. Areas of greater confirmation generally become the areas where price reversals take place. These reversals are also generally larger. After a steep downtrend from a triple top reversal in early 2018, price reversed sharply back up at the approximate zone marked number 1. It went slightly below what was originally drawn, but that's to be expected due to the major reversal with exceedingly high volume. Price overshooting is very normal. The next two upswings, marked number 2 and number 3, were well within their respective zones. Notice how they don't have price overshoot. This was because price was not in a sharp downtrend and or on exceedingly high volume, like with reversal number 1. The downward reversals marked in red also follow a similar pattern and do not overshoot, as price movement and volume were normal and not exceedingly high. Next, focus on the highlighted zone where reversals did not occur, namely the large 0.382 fib level at 312.54 to the 0.618 small fib level at 308.63. From June to July, marked with a gray square. Price stalled at this zone for 2 days before resuming back down. The downtrend eventually passed this area because there was sufficiently higher than normal volume. When price went through this zone on the upside later in July, it was passed on regular volume. This is normal because in the context of both the large and small fib, price only went back up through 2 fib levels. If price passed the zone on regular volume after passing 3 or more fib levels in the small or large fib, this would be exceedingly rare. The small 0.5 fib level at 319.05 is highlighted in purple. It demonstrates the concept of a single fib level being less likely to be the area of a reversal. Even though it is a less relevant level, it still demonstrates why it is important not to ignore it outright. Here it exhibits the other characteristics of fib levels that are not complete price reversals. Instead, it was an area where price was temporarily supported or resisted, meaning up and downtrends were temporarily halted. Price is stalled or congested around the fib level before resuming its previous direction. Furthermore, price action during these stalls or congestions is very low, meaning no major move in price takes place. Volume also typically remains normal or slightly below normal. When price does move out of these stalls, it usually does so with larger price action in terms of a larger price movement and on normal or higher than normal volume.